Warren Buffett's 10 Golden Rules of Investing. Explained with stories. What if you could sit in the same room as Warren Buffett and hear his greatest investing secrets? This man turned a few $1,000s into over $100 billion in net worth, not by gambling, not by chasing trends, but by following timeless rules that anyone can apply. Today, you'll discover Warren Buffett's 10 Golden Rules of Investing. I'll explain each one with real stories from Buffett's life, examples of his investments, and lessons that you can use right now to grow your wealth. Stay until the end, because rule number 10 is the most powerful rule Buffett ever shared, and it has nothing to do with the stock market. Rule 1. Invest in what you understand. Buffett once said, "Never invest in a business you cannot understand." Think about it. When he started, people were rushing into complicated companies. Buffett stuck to businesses he could explain in a few sentences. Example, he avoided tech stocks in the 1990s. Even when everyone else was hyped about them, people laughed at him. But guess what? When the dot-com bubble crashed in 2000, Buffett's portfolio survived while others lost everything. Lesson: if you can't explain how a company makes money in plain language, you shouldn't own its stock. Rule 2. Think long-term. Buffett's favorite holding period: forever. He doesn't care about the stock price today or next month. He cares about whether that company will still dominate 10, 20, or 30 years from now. For example, he bought Coca-Cola stock in 1988 after the crash, and more than 30 years later, he still holds it. The dividends alone have paid him back more than his original investment, while the stock price multiplied many times. Lesson: don't think like a trader, think like a business owner. Rule 3. Focus on value, not price. Warren Buffett uses this analogy. If you were buying a farm, would you check its price every day? Or would you care about how much corn it produces over time? The same goes for stocks. They are not lottery tickets. They are ownership in real businesses. When Buffett bought Apple, he didn't care about daily fluctuations. He looked at Apple's loyal customer base, its ecosystem moat, and its cash flow. That's why it became his largest holding. Lesson: price is what you pay, value is what you get. Rule 4. Be fearful when others are greedy. This is Buffett's most famous line. But what does it mean? Look back at 2008. During the financial crisis, everyone was panicking. Buffett stepped in and invested billions in companies like Goldman Sachs and Bank of America. At the time, people thought he was crazy. But when the market recovered, those investments made Berkshire Hathaway billions. Lesson: the best time to buy is often when the world is in fear. Rule 5. Don't lose money. Rule number 1. Never lose money. Rule number 2. Never forget. Rule number 1. Of course, even Buffett makes mistakes, but this philosophy is about protecting your downside. He avoids risks that can wipe you out. For example, he avoids businesses that depend too heavily on debt. During recessions, over-leveraged companies collapse, but Buffett's companies survive. Lesson: focus on safety first, profit second. Rule 6. The power of patience. Buffett compares investing to baseball. The stock market is a no-cold-strike game. You don't have to swing at every pitch. Translation: you don't need to invest every week, every month, or even every year. Buffett often waits for years before making a big move. Example, he sat on billions in cash for a long time, waiting for the right opportunities. When the 2008 crash came, he was ready. Lesson: patience is not just a virtue, it's a strategy. Rule 7. Avoid debt. Buffett is very clear. Avoid heavy personal or investment debt. He once warned that debt is like a knife. It can help you, but it can also kill you. Most billionaires you hear about used leverage, but Buffett built his empire mostly with cash and reinvested profits. That's why he never had to sell at the wrong time. Lesson: avoid credit card debt, risky margin trading, or borrowing to invest. Debt reduces control and magnifies mistakes. Rule 8. Invest in quality businesses. Buffett looks for economic moats, advantages that keep competitors out. Example, Coca-Cola's brand is priceless. Even if a new company tries to copy it, people stay loyal. Another example is See's Candies, a small chocolate company Buffett bought in 1972. It cost just $25 million back then, but over the years it earned him more than $2 billion in profits. Why? Because people keep buying See's for holidays, birthdays, and gifts. Lesson: look for companies people will still love in 20 years. Rule 9. Learn constantly. Buffett spends 80% of his day reading. He calls knowledge compound interest for the mind. As a teenager, he read hundreds of books about investing. Even today, he reads annual reports, newspapers, biographies. Lesson: the more you learn, the more your money decisions improve. Every book, every article, every case study adds to your advantage. Rule 10. The best investment is in yourself. Buffett says, the best investment you can make is in yourself. He means your skills, your knowledge, your habits. Stocks can crash, currencies can fall, businesses can fail, but no one can take away your abilities. Buffett himself was terrified of public speaking as a young man. He forced himself to take a Dale Carnegie course. That skill, being able to communicate clearly, helped him in business, investing, and life. Lesson: build yourself, and the returns will multiply forever. The magic of Buffett's philosophy is that it's simple. No fancy formulas, no chasing fads, just discipline, patience, and clear thinking. If you follow these principles, you won't just invest like Warren Buffett, you'll think like him, and that mindset can change your financial future forever. Now, here's something most people don't realize about Warren Buffett. Yes, he's the world's greatest investor. Yes, his rules are timeless. But the real secret behind his success is not just in picking stocks, it's in his mindset and lifestyle. Think about this. Warren Buffett still lives in the same modest house he bought in Omaha in 1958. He could buy mansions all around the world, but he chooses simplicity. He once said, "Success in investing doesn't correlate with IQ. What you need is the temperament to control the urges that get other people into trouble." And this is the part most people miss. The stock market isn't just about numbers, it's about emotions. Fear, greed, panic, excitement. These destroy more investors than any market crash ever could. Buffett mastered his emotions. That's why he wins. Another thing to notice, Buffett built his fortune slowly. Decade after decade, compounding turned small sums into billions. He often says, "Someone's sitting in the shade today because someone planted a tree a long time ago." That's the power of starting early and letting compounding do its magic. The sooner you begin, the bigger the shade you'll enjoy later in life. And finally, Buffett's story teaches us something beyond money. The truth is, he doesn't just measure wealth in dollars. He once said, "When you get to my age, you'll measure your success in life by how many people truly love you." That's the ultimate lesson. Investing is not just about financial freedom, it's about the kind of life that money allows you to live. Freedom, security, peace of mind, and the ability to help others. So if you take one thing away from Warren Buffett's philosophy, let it be this. Keep it simple, be patient, think long term, and remember, the greatest investment you can ever make is not just in stocks, but in yourself, your future, and the people around you. Because wealth is not just about money, it's about building a life worth living. Thank you for watching until the end. I hope you found Buffett's wisdom both interesting and useful. Remember, investing is a journey, and the sooner you start, the stronger your future will be.